Hello, hello, hello. Can you hear me all right, Mr. Blockland?
Yes, can you hear me?
Yes, I can. It sounds like the timing of this particular chat is I don't know. I don't know if it's a fortuitous one, an ominous one, but there's a lot going down in Europe today. So I feel like we'll be able
Yeah.
to kind of jump into your expertise and hopefully learn a thing or two. Before we get into that, I kind of gave the audience a little bit of a rundown of who you are, what you do. I'll make sure your Twitter, your YouTube channel, but basically you run True Insights, which is all about I kind of like multi-asset thoughts and portfolio management and all of that. And right here in the US, we talk quite a bit about what's going on with Jerome Powell, who was just speaking this morning, our own interest rates, what's going on. And once in a while, we get the headlines here of what's going on with the ECB. And we're hearing a lot about the energy issues going on in Europe right now. And then that ties to things going on in China. And I think this could be a good opportunity for quite a few of the retail traders and investors in this audience to learn from someone who's been around the block a time or two. So could you quickly just introduce yourself, give us a little bit about your background, and then I kind of want to jump into the ECB decisions from this morning.
Yeah, sure. Okay, yeah, so my name is Jeroen Blockland, and I am a multi-asset investor. I have done so for the last 20 years or so. I used to work at Robeco, which is one of the biggest pure play asset managers in the Netherlands. And indeed, then I started my own firm. And what we create is multi-asset investment research, trade ideas, investment opportunities. We help people construct well-diversified portfolios and then twist that portfolio towards those asset classes that offer the best risk return prospect. And also, I think we have some nice stories around it. So I write stories about what is happening in markets. Like, for example, tomorrow will be about the ECB. So this is a good topic to talk about.
Definitely.
And that is basically what we offer.
Awesome. So now jumping right into the ECB. So to my understanding, before this, the interest rate was at negative 0.5. Then they brought it to zero. And then as of this morning, it was an unprecedented jump of going from zero. It was 75 bips. And what I'm a little bit confused about with that, so for all those watching, it's basically just saying, hey, they're starting to turn hawkish. They're fighting the inflation. I believe the August numbers over there in Europe was 9.1%, so very
Yep.
similar high elevated level to the US. My
Yep.
question there is, why does it seem to me on the surface level that the ECB is kind of lagging behind the US central bank? We've been a bit more aggressive. I think we even kind of tapered off our quantitative easing before the ECB. We started rate hikes before the ECB. So is there a play here? Because like the ramifications are the dollar index, Dixie's just running, running, running. We see the Euro USD parity coming down to 1. Was this a planned thing, or did they think that maybe the economy didn't recover enough? Because what I'm seeing, and like maybe it's a little bit of doomsday, but doing interest rate hikes into this crazy energy issue that Europe is now facing, like that's
Yeah.
not good. That's going to put more downward pressure on your local markets, but also the economy. So am I missing
Yeah.
something?
No, I think there are three reasons why they are so late. First of all, like the Federal Reserve, they underestimated the effect of inflation. The only thing is that Lagarde she did a little bit of that today, but she's a little bit more hesitant to admit than Powell. Powell has been very clear. We have been underestimating inflation. We were too late, and now we're going to catch up. So that is one thing. The ECB is behind in that acknowledging. Second, you mentioned the energy crisis. Well, that is, of course, much more acute in Europe because Europe is getting cut off from cheap Russian gas. And that means that countries have to scramble for alternatives. Yeah, the faster you want the alternative, the higher its cost. It will take time before you can create new supply chains. So the immediate effect is much bigger there because, of course, the US has its own energy resources. So that makes it more, let's say, extreme. This is also why headline inflation is now higher in the Eurozone, even though the economy is weaker. But having said that, and the third thing, and I think this is very important, that Whereas the US, the Fed has one country to focus on, and that is the United States. But in the Eurozone, you have Germany and you have Italy, and these countries are totally different. So there's a lot of talk always about the debt to GDP ratio of Italy. That is 150%. Basically, that means that Italy cannot tolerate a massive rate hike. This is also why the ECB has created this new liquidity program. They call it differently. It's called the Transmission Protection Instrument. But basically what that will do, if it is activated, it will buy Italian government bonds the minute that the ECB thinks that the level of the rate is not sustainable for Italy. Now, to get this in place, that took quite a bit of time because they also had all these other programs, and to make sure not to give markets a reason. Markets want to test central bankers. So if the situation around Italy is not already fully protected before you start raising rates, then of course you allow the market to test the ECB by increasing the rate on Italian bonds. So basically these three things had to happen first, and now and I don't know if you watched the press conference, but now Lagarde has turned from a somewhat dove to an actual hawk. So she thinks there will be more rate hikes, also another 75 basis points. The next meeting for the ECB is in October, is also on the table. But yeah, I think these three factors make it that they are even further behind the curve, as they say, as the Federal Reserve is.
Yeah, that's almost now mimicking what's going on. And I was looking at the bond market prediction, and it looks like we have our next FOMC meeting in 2 weeks. The inflation report comes out next week, but it's the last time I checked, over an 80% chance that we're about to have our third 75 bips rate increase. So it's interesting to see that now that I guess the Italian situation is a little bit more under control, that both of these central banks are essentially doing the same thing. But then for those, like, this is a lot of high level talk, and I think it's probably confusing because it's a complex thing. So maybe a better way to summarize this is, in your view, whether it's the medium or longer term, how do you think this plays out in the markets? Like, in your opinion, if you were sitting there with someone at the pub explaining like, hey, like, I think the market's going to be actually turning around pretty soon, or do you think there's more pain ahead? If we're talking in the larger picture, what's your knee-jerk reaction of the current situation?
Yeah. So I have a clear idea of what the narrative is going to be. So every central bank that we are talking about now, Bank of England, ECB, Federal Reserve, they will all do the same. They will, as Lagarde also front-loaded, so they will try to get in more rate hikes now, so increase more and do these 75 basis point steps to make sure that if things go down the drain, if the economy, the European economy will go into a recession, I think that by then it will be much more difficult to continue to hiking rates, even though inflation will still be above a target. So you see that every central bank does the same thing, and that is try to get in as much rate hikes as possible. And then in the end, someone has to give first. And my guess is that the ECB will give in first because they are facing the recession. And the minute this happens, they will pause rate hikes. And that has a big implication of two things. First of all, the euro will collapse further. It will, even though they have now the same amount of rate hikes, of the same pace of rate hikes as the Federal Reserve, my bet is that the ECB will continue to, the euro will continue to weaken. First, as you mentioned as well, the Eurozone is almost in a recession. So if you go on aggressively, you will make the recession worse. So that is one thing. But I think at some point, the ECB will blink. They will be the first of these major central banks that I mentioned to hold. I don't think they will cut rates immediately, because that would, again, raise questions about the credibility as inflation fighters. But the minute they hold, the euro will take another hit. Also because markets think that the ECB will raise another 180 basis points in the coming meetings. So if she doesn't get there, the euro will fall. The other thing is that the moment that Lagarde says, okay, the economic situation has become so dramatic that we have to pause our rate hikes, by then by then the recession pain for equities is already done, and the central bank pain will end. So we get a massive rally in risky assets. But because all of these central banks are doing the same, more rate hikes, more rate hikes, more rate hikes now, as much as possible before things really get broken. This is too early to expect that, and this is also why equity markets are pressured still. But the minute that Lagarde says, okay, maybe a little bit less or no more rate hikes, I think that would be an excellent time to buy equities.
Interesting. So with all of that, I think it's fair to say you're almost saying that there might be a play in shorting the euro, which conversely means going long on the dollar index. Like that would both
Definitely.
like the same thing. And then as soon as this happens, and this is common, and I've even talked about it with the audience of typically you actually see stocks bottom out before the economy bottoms out. And I think you're just saying that in a different way of like, okay, as this is going, yes, from a monetary standpoint, things could get worse, but we'll see and then you're also taking it to the next level of high risk. And I've read quite a bit about that. If people are looking at the higher risk, higher growth tech stocks, maybe even a little bit of the world of crypto. And we could talk about Bitcoin in a bit. So you're going to be looking for that as soon as the ECB starts to blink. That's like the first thing you'll be pulling up on a watch list almost.
Yeah. So on the euro, I think so. So we have been short for quite a while. But I still think I put out a video yesterday. I still think this is actually it still offers value to short the euro or long the dollar, whichever angle you want to see it. It's the same trade, of course. I feel this is still the case because first we get this pain, the tightening pain, and we get the recession pain. Now, the Eurozone is much closer to a recession than the US. That is also most of the time bad news for your currency. And what I will try to do, of course, but as mentioned, is too early that the minute that I think that the ECB will blink, before she has done it, and before Lagarde has changed, then I want to be long, of course. But that is indeed the case. You want to get. It doesn't matter what she has done now. It matters what she will do from here, and that is what you'd have to try to anticipate. And I don't think that the ECB will get the chance to hike as much as 180 basis points from here. What is now expected by markets. So the minute that markets realize this is also not the case, that feels as a relief. Oh, no more tightening. Okay, long equities.
Gotcha. I truly appreciate that insight. Switching it a little bit to the world of energy, I would love to hear your like the facts and figures, but maybe it first started off a little bit more anecdotally because I'm just reading these stories of people, their monthly energy bill in Europe is like up hundreds of percent. Have you personally experienced that? Have some of your neighbors? And then beyond that, I would just love where you think from a macro perspective, what's going on with natural gas. I know is big right now, especially with Germany and Russia, but also just even petroleum and OPEC and all that good stuff.
Yeah. Well, on the personal side, so I am an analyst. So what I discussed with my wife a couple of years ago, I wanted to have a long contract because Russia is not the only problem. Russia made things worse, but there was always going to be an energy issue in the Eurozone in Europe. So that is one thing. The second thing, and then that is enough about my home situation, but I have a heat pump. It gets a heat from out of the ground. So I don't need natural gas to heat my house. Okay. So I think I'm the outlier because heat pumps are now very popular, of course, also because of this. But I live in a house. They put one in 20 years ago. I did not know anything about it before, but it works perfect. So I have a fixed price for a couple of years. It's not endless, and I have this heat pump. It does not use gas to heat my house. But I did some math on it in Germany. So because that's the bigger economy than in the Netherlands. I'm Dutch, but if you look at the expectations about the energy bills, so last year, and this was already a little bit elevated, German households on average paid almost 5% of their disposable income on energy. Now, if you look at the inflation basket, in the inflation basket, it is 4%, so it's close. But it will now rise based on the projections of some of these German statistical office and things like that to 14.6%. So almost 15% of your disposable income is estimated to be gone on energy. Now, you know what that means for the rest. You have to buy less. And this is why governments have to compensate. They will do so. And you see all of these stimulus efforts, relief packages, whatever they call them, you see popping them everywhere. So also the new British Premier, the first thing she did was to announce a big package to relieve households from this massive rise in energy costs. So yes, it's pretty big. It goes from 5% to 15% of your disposable income.
Wow, that's truly a jaw-dropping number. But if it goes that way, obviously the government is going to be stepping in. But then tying it back to the first thing we talked about, won't that make inflation worse if the government's stepping in with the stimulus? Won't that make the job more difficult on EC? Like it seems like a very negative snowball effect of how this is now all playing out. Or am I missing something?
No. Lagarde in her press conference exactly mentioned this, that she basically said to governments, please do what is needed, but nothing more, because that would make things worse. This is also the interesting thing, that Lagarde still thinks that a lot of inflation is demand driven. So if you give people money to pay their energy bills, that could theoretically push up inflation further. But what you see, it's much more a supply impact because of this energy and other supply chain issues, and the ECB has zero impact on that. So what could happen is also that inflation will come down massively, because you have these supply effects. Now they are now going to regulate that, so the year-on-year changes in energy will go down dramatically. But then also, if you don't give households the relief they need to, also the demand side will also take a worse hit. So it is already being hit, but even more. And that means in a recession, inflation goes down every time. So if you look at some of these forward-looking indicators, it could well be that in 6 months from now, we are still talking about that the central banks and the ECB have got it wrong again, because inflation is going to plummet massively. It depends on the deepness of the recession, but some of my forward-looking indicators suggest that inflation could go to zero within 6 months. I don't think it will happen because there's this stickiness, but we should not rule out, if you kill demand, if you have a recession, then who's going to buy stuff? Everybody has inventories. You only get rid of inventories if you lower your prices. Ask Walmart.
Yeah. I mean, it sounds like a very roundabout way to kind of Paul Volcker the whole situation. Obviously, he did it with interest rate hikes, and now it seems like this time it might be played out with a combination of interest rate, but also what's going on in the world of energy. But it's not, I wouldn't say manufactured recession, but it's classic supply and demand. And no central bank in the world is going to impact supply. All they can do with is try to push demand up or bring demand down. And that's in a roundabout way, we're just really shoving demand down. And speaking of other central banks, I believe a week or two ago, and please correct me if I'm wrong, I read that actually China decided to cut their interest rates, which I think kind of freaked people out, because then it signaled to the rest of the world. We were talking about who might blink first. Well, you can almost argue China already blinked first, because they're signaling to the world that their economy is not that strong, that they had to actually already do a rate cut. But on top of it, and I don't know if it does or doesn't play into it, I've been reading crazy stuff about their real estate sector, of how, like, I mean, I don't legitimately need pyramid scheme, but all these building guys that they basically had to get bailed out by their own government. So that's a whole nother debacle. Do you have any in-depth thoughts on that?
You're actually pretty right. So the last time that China cut rates was back in January, and then they made it very clear that they didn't want to use that instrument anymore, and that has to do that they don't want to weaken their currency. You have seen, look at the Japanese yen, but also now the euro. The minute that you diverge from the Federal Reserve monetary policy, your currency goes down the drain. So this is the big risk. Now, obviously, China does not want that to happen. Also, because this is an important input in our framework, the correlation between the yuan, the Chinese currency, and markets is negative. So if the yuan goes down, equity markets also go down. So it has to get stronger. And this correlation is pretty strong. But yes, again, they felt the need to add to the interest rates, or to pull the interest rates back into the monetary policy picture, taking every risk about the Chinese currency. And this, of course, has to. So arguably, the Chinese real estate sector is the biggest asset class in the world. It's It's huge.
Oh.
It's extremely. There are charts that suggest that if you add a certain value to home prices or home values, that this could be the biggest asset class in the world. So that is also, and that also makes it a very big problem to ease. And what you see now, the big problem is that a lot of these property developers, instead of finishing the homes that they promised to to people, they have bought new projects, new land, and started new projects. And now that they are without cash, so the biggest property developer in China reported a 96% decline in earnings. So there goes your cash. They simply are not able to finish those unfinished homes. They don't have the money to make the construction complete. Meanwhile, Chinese consumers and homeowners have to pay mortgages on their unfinished houses. So this is also why you hear about this mortgage boycott. They don't want to do it anymore, and for good reasons. And I completely understand you don't want to pay for a home you may never live in, and that is and the problem is of such a large size that they decided to lower rates to make mortgage rates lower. At the same time, they also are giving cash injections to these property developers to continue building, because that is what now has to happen. But yes, this is a big problem, and at the same time, because they lowered rates, they also had to do all kinds of things on the currency side to prevent the yuan from weakening, which it is still weakening. I can have a look. It's very close to that magic level against the dollar of 7. But you see, and again, so I take it, okay, the yuan is kind of a sentiment indicator. Yeah, it makes things worse. So first, we had Powell, he took away the monetary policy pivot, the belief that the Fed would change course anytime soon. They took it away, and now we have this other factor on the other side of the world, which has to cut rates, but knows my currency will weaken, so I have to intervene in the currency, and this also means, and there's also what you see, that overall volatility in the market is really, really high.
Yeah. So, in a way to connect this all together, and I do want to get into Bitcoin for a second, but before we do that, so we're talking about craziness in the central banks in the US, in Europe, and really globally. We have a crazy energy situation globally, but also more so in Europe. We didn't get into it, but there's many articles of what's going on with like droughts, potential famine, and that actually all getting worse. And then we have this real estate debacle that's coming out of China. So in a concise way, I guess, like if you're looking at the major markets here in the US, the Dow, the Nasdaq, the S&P, something like that, I'm seeing a lot of these big banks, the fancy schmancy analysts with the pedigrees on their wall, they seem split. Some are saying, nope, the June low is the low of the year and everything's going to be fine. And they're saying a recovery by the end of the year. And then there's other people, other fancy schmancy analysts who are saying, actually, we have quite a bit more pain to endure. What camp are you on? Now, obviously, I'm not going to hold you to it. We don't need a specific number, but do you think there's more pain, or do you think we're actually like kind of close to the end of like the drawdown in the market?
Now, the point is, everybody's staring at that 3,600 and something because that was the bottom. But that is not relevant because we live now. I want to know, we are now at 3,900. Do we go down, go up? And more importantly, do equities go up relative to some other asset class, or do they go down to some other? That's my game. And gotcha. I think in the short term, and that fits a bit my narrative, that you will see all of these central banks wanting to tighten because inflation is too high in an already slowing economy. Now, that is very difficult for equities to cope with. If you then also look at what is expected for earnings growth, for example, earnings growth is still expected to be positive. But in every major slowdown and in every recession, of course, earnings per share fell on average. Okay. So a slowdown is enough. It does not require a recession, but a big slowdown is enough. Yeah, these are still positive. I think for the US, it's now 9% expected earnings growth in the next 12 months. It's not going to happen. It's not going to happen. So I think that equities have to revalue still on the deteriorating macro environment plus two exuberant earnings estimates. So that is one thing. The second thing I want to add, and that is also that makes that if you look at what equities are pricing for some of the macro indicators, for example, the ISM manufacturing, one of the well-known indicators, they have priced in quite a bit of a slowing already. Yeah? So I don't know if we're going to hit that 36. I think for now, the next couple of weeks, perhaps months, the odds of equities underperforming other asset classes is relatively high. Okay. But I'm certainly not a doomsayer that things have to go to below 3,000, because there is some things priced in, and that is also so it's a relative game. So yes, for now I am underweight equities. I think the odds of going lower are higher than going higher, but I'm not extremely bearish. Let's say for the 1 or 2 years or so.
Gotcha. And then that's a perfect segue to kind of our final thing here is other asset classes. Just a higher level view. There's a lot of discussion about Bitcoin just because out of nowhere, there were a bunch of people who YOLO'd into it when it was a couple bucks and they became millionaires overnight. It ran up to 69,000 in November. Right now, I think over Father's Day, at least here in the US, it got down to 17. Yesterday, I think it was below 19. That's quite a bit of a drawdown. Do you think it's a good store of value? Is it something you're interested in? Do you think it's a complete farce and you shouldn't touch it with a 10-foot pole? Where's your mindset of just Bitcoin as a long-term investment, an alternative to gold? Let's call it a digital gold.
Yeah. So first of all, in Bitcoin, everything is extreme. So I like to think that I'm right in the middle. Where do I see value in Bitcoin? From a macro perspective, in that it can represent some kind of, let's call it an insurance premium for bad things. And for some people, these bad things are high inflation. For some things, these people are much worse. The collapse of the financial system, I think that is too bearish, but for bad things. And in that sense, in a lot of others not, but it reflects a bit of gold, because you can. If you look at the price of gold, the value of gold, and you compare that to other precious metals, then gold is way too valuable. It costs much more, and that is because gold used to be money, and gold is seen by a lot of investors as a store of value, and that is why it gets its value from. So if you believe that Bitcoin can take away a bit of that insurance premium, then I think you should not underestimate that Bitcoin is an asset class with value. That's one side. The other side is, of course, that the uncertainty around that is massively times higher than for gold, which already has proven itself. And this is why you get these ranges that you mentioned, but also that you get realized volatility. So the risk of this asset class is almost 5 times higher than equities, which are already the most risky asset class. And if you want to incorporate Bitcoin into your portfolio, that's fine. We do that as well. But you have to take into account that you take a somewhat uncorrelated, debates are up for that, but so it moves in its own way, and it gives you 75% of volatility. So it goes everywhere. If you add that for 50%, then people, that for me does not mean that you are multi-asset investing again. You are Bitcoin investing and do something else a little bit. So that is the second message I want to give. I think it could have value. It's very risky, but it could have value in this whole insurance premium. But if you add it, you have to be very aware what it does for your overall investments, for your overall portfolio. And that is what I try also with my research. I try to show if you add 2.5%, 5%, 10%, what happens to the characteristics. So if you trade Tesla all day and you add Bitcoin, not that much changes to your overall risk profile. And if you are fine with that, go for it. But if you think I also need a little bit of commodities and a little bit of gold and a little bit of bonds, if you then add 20% of Bitcoin, then you are changing your risk profile. That is fine if you want to, but most people don't recognize that are doing that. And that is exactly, I'm somewhere in the middle. I don't think it's worth nothing. I also think that it will take over everything, and it will be the reserve currency and kick off the dollar off its throne within a couple of years. I don't think that either. It's not going to happen.
Well, I truly appreciate your insights, and honestly, this entire chat, very illuminating. It was an absolute pleasure. If people have follow-up questions and they want to reach out to you, what's the best way? What's your Twitter handle? What's your website?
Yeah, my Twitter handle is @JS Blokland. So maybe we should put it somewhere. And my website is True Insights. .net, I should say, and there's a dash between true and insights.
Awesome.
So if you type true-insights.net, you should be able to find it. You can ask questions by a mail form and things like that.
Awesome. I will put your Twitter, your YouTube channel, and your personal website on the description of the video for this particular interview. But once again, thank you so much. And I'm interested myself to see how this all plays out with your Euro call and the bottoming of equities. But clearly, we're in a high volatility time, which if you know what you're doing, that represents a lot of opportunity. So the fact that you took time out of your day to discuss it with a bunch of retail traders and investors, honestly, it means a lot to me. Thank you so much, and we'll be talking soon. Have a good one.
Okay, you're welcome. Bye.
Bye.
Ciao.